Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
You know you're getting old when you stoop to tie your shoelaces and wonder what else you could do while you're down there. There is no we in food. Jim Gaffigan, when you are dead, you do not know you are dead. It is only painful for others. The same applies when you are stupid. Why is everyone taking pictures of their food? You're not going to look at it later. Remember that taco, those were good times. Giving money and power to government is like giving whiskey and car keys to teenage boys.
The Nasdaq 100 isn't exactly on sale, but is no longer wearing a luxury price tag either. It's now trading at around 23x forward earnings, almost exactly in line with its 10-year average PE of 23x, according to Goldman Sachs. That's also near the lower end of its last 3 to 4 years valuation range. For investors, that means today's market is being supported more by earnings expectations than by expensive valuations. AI and big tech still need to deliver, but at least valuations aren't asking for a standing ovation. Big tech's AI spending spree is no longer just an equity story. It's becoming a bond market test. Amazon's latest $25 billion bond sale attracted a final order book of just 1.6 times, the second weakest demand among this year's tech mega deals ahead of only Salesforce. Collectively, Amazon, Alphabet, Nvidia, Meta, Oracle, and SpaceX have raised a staggering $182 billion in investment-grade bonds in 2026. Investors are still lending, but they are no longer throwing money around like confetti. The AI race continues. The enthusiasm is simply asking for a higher coupon. Japan's debt often grabs headlines, but the net debt story is far less dramatic. Unlike many countries, Japan holds substantial financial assets and foreign reserves, so net debt to GDP has been steadily falling, even with gross debt remaining high. Meanwhile, its interest bill is still remarkably low, especially compared with the US, where interest costs have climbed sharply as a share of GDP. Yes, higher JGB yields will eventually lift Japan's borrowing costs, but what really matters for debt sustainability is the real interest rate, not just the headline yield. Sometimes the loudest number isn't the most important one. Gold may dominate the headlines, but copper is quietly winning the revenue race. The world's 100 biggest miners generated $730 billion in 2025 revenue, with just 22 copper companies accounting for 28.1% of the total. By comparison, 39 gold miners contributed only 21.3%, while five iron ore giants delivered 22.4%. Even more striking, Glencore alone earned $63 billion, more than the entire coal sector demand combined. Turns out digging up more doesn't always mean making more. In mining, it's the quality of the paycheck, not the size of the shovel. Emerging markets have a new power duo. Taiwan and South Korea now make up nearly half of the MSCI Emerging Markets Index, driven by the AI and semiconductor boom. This year alone, South Korea is up 115.6% and Taiwan has gained 57.6%, while China is down 16% and India has slipped 9.5%. It's a remarkable reshuffle of market leadership. The irony, just 2 years ago, India was everyone's favorite. Markets, it seems, have the attention span of a goldfish with a Bloomberg terminal. The oil market has found a new headache. It's no longer just an oversupply story, it's becoming a price war. Saudi Arabia is already selling crude below the Dubai benchmark, signaling producers are willing to undercut each other to protect market share. The latest EIA July outlook also points to persistent inventory builds through 2027, a clear sign that supply is expected to outpace demand. When everyone wants to sell and nobody is rushing to buy the next barrel, prices usually don't win the argument.